Imagine a scenario where the team with the highest payroll in baseball, a figure exceeding $417 million in total commitments this season, is legally paying its biggest, most marketable superstar a mere $2 million a year on the current books. That sounds less like savvy business and more like financial sorcery. Yet this is the hyper-aggressive, perfectly legal reality engineered by the Los Angeles Dodgers, a strategy that is simultaneously building a potential dynasty while arguably holding a ticking time bomb pointed directly at the competitive balance of Major League Baseball.
Welcome to 601 Daily News, where we track the hidden economics of victory, dissecting how the Dodgers aren't just winning games, but are rewriting the financial playbook of professional sports, potentially sacrificing their future solvency for immediate, unparalleled glory. The numbers are staggering, a monument to ambition that borders on hubris.
This year alone, the Dodgers' commitment far surpasses the competition. Their expected luxury tax payment sits above $169 million, a number that is virtually double the total payroll expenditure of the league's second highest spender, the New York Mets, and eclipses the combined yearly spending of perhaps 5 smaller market teams. This massive fiscal gap has been facilitated by an artistic, almost predatory use of deferred compensation, most famously exemplified by Shohei Ohtani's $700 million contract, where $680 million is pushed far into the future. For the proponents, this is simply the apex of competitive ingenuity. As one fictional financial analyst, let's call him Mr. Kuroda, noted in a recent seminar, the rules are the rules. If you possess the market leverage, the corporate backing, and the star power to attract the biggest names and negotiate terms that capitalize on future revenue streams, you absolutely should. This is enterprise. This is about wanting to win, plain and simple. What are we supposed to do? Unilaterally disarm because other owners can't generate the same revenue?
The argument here is simple. Every player agreed to the contract. Every transaction was within the bounds of the current collective bargaining agreement, and the Dodgers, by generating immense popularity and success, like potentially achieving a World Series three-peat, will only raise the visibility and revenue pool for the entire league. They believe their investment is not just self-serving, but ultimately a rising tide for MLB.
However, a deep, pervasive anxiety is building across the league offices, particularly in smaller markets. This is where the sharp argumentation begins. The Spanish sports daily Marca echoed these concerns through an unnamed correspondent, arguing that the financial gulf has reached an unsustainable, frankly unconscionable level. Let's put this in the perspective of a team like the Pittsburgh Pirates or the Kansas City Royals. Their entire operational payroll for player salaries might hover around $85 million. When one team, the Dodgers, is paying a luxury tax penalty of nearly double that amount just for exceeding the threshold, we are past mere competitive disparity. We are entering an extinction event for parity. As fictional investigative journalist Elena Sanchez stated emphatically, what we are seeing is the functional destruction of competitive balance. Smaller markets are no longer allowed to compete. They are relegated purely to the role of glorified farm systems, forced to breed talent only to sell it immediately to the handful of hyper-rich clubs. This isn't competition, it's annexation. The small market teams are forced to rely solely on internal development, watching their prized assets walk away the moment they are eligible for substantial paydays, thereby creating a cycle of perpetual rebuilding. The core of the conflict, the great mystery we need to resolve, is the inherent danger of this strategy, the deferred time bomb. While the immediate benefits are clear, the debt is accruing, and that debt is corrosive. The future Dodgers GM, let's call him GM-X in the year 2034, will inherit an operational nightmare. Imagine receiving a budget report detailing that $70 million of the annual salary expenditure is earmarked for players who have already retired or are playing for other teams. The current structure requires the Dodgers to operate as if they are paying Ohtani his full $70 million annually today when accounting for the competitive balance tax, but the actual cash leaving the coffers is minimal. This works brilliantly when cash flows are explosive, driven by championships and massive attendance. But what happens when the tide turns? What if a series of bad contracts, poor performance, or, heaven forbid, a future labor stoppage drastically reduces their revenue? The debt does not care. It sits there, compounding, demanding payment in dollars that, due to inflation and the ever-rising MLB salary floor, will be significantly less valuable than they are today, but the sheer volume will be paralyzing. I inherited a team paying $70 million a year to ghost players, GM X in 2034 might lament to his reflection. I look at this spreadsheet and all I can think is, stop the bleeding. But I can't sign new talent because our budget is crippled by the legends of yesterday.
This leads us to the sharpest counterargument and the climax of this debate, the 2026 labor dispute. The current CBA expires right when the deferred payment issue hits critical mass. The smaller teams and the MLB Players Association are already eyeing this accounting trickery. While many critics argue that deferred payments benefit the player by guaranteeing money over a longer term and providing tax benefits, the true hazard is that the MLBPA will likely demand rules that mandate current annual cash flow must more accurately reflect the AAV for competitive balance tax purposes, essentially eliminating the ability to defer such massive amounts. The looming plot twist is this. The Dodgers are gambling that their success over the next 3 years is so overwhelming, securing multiple championships, that it permanently enshrines them as the premium destination, guaranteeing future revenue spikes that dwarf the incoming debt payments. They are betting that the revenue gained from Ohtani's popularity and World Series rings will outpace the eventual cost of the debt.
It's not a legal loophole. It's a massive, calculated risk on future economic growth. If they fail to capitalize on this window, the future is grim. If they succeed, however, the argument that it was legal and profitable becomes irrefutable, leaving the rest of the league, particularly those focused only on enterprise effort and ignoring the structural economic constraints, scrambling to catch up.
The Dodgers aren't breaking the rules. They are playing a different, financially riskier game than anyone has dared before, turning the league into a two-tiered system. The Dodgers and everyone else, hoping they don't go bankrupt in 2035. So, tell us in the comments, is this deferred payment strategy a stroke of genius that competitive teams should emulate, or is it a toxic financial bomb waiting to explode the 2034 Dodgers? Hit that like button, subscribe to 601 Daily News for the deepest dives into the business of baseball, and share this analysis with anyone who thinks baseball is just a game.